Let's get to Dan Lacalle, who is chief economist at Tressis Gestion. Dan, nice to see you again. We started out the show talking to one of our guests who was saying we are poised for some form of a sizable move on markets, but he just couldn't call which direction. I know that you think there is potential for downside in October. Just flesh that thought out for us.
Well, good morning. I believe that what we're likely to see is first the backlash from very aggressive expectations and very optimistic expectations about the recovery. But the recovery pace remains. It's just that we have seen too aggressive estimates being embedded in earnings and in macro growth projections. So I think that added to the fact that we see a little bit of tapering from the ECB, tapering from the Fed, and concerns about the Chinese slowdown are likely to generate a correction. But we must remember, and I think that this is what's important, is that despite the concept of tapering that is being told, what we are going to see is that the Fed and the ECB will continue to be more than 100% of the net issuances of sovereigns. Therefore, the risk of a spillover effect to the sovereign debt market or a very aggressive correction because of these factors that I mentioned, to me is more difficult. I think that what we are likely to see is simply a little bit of coming back to reality, based on a multiplier effect of government and monetary policies that have never been generated that level of multiplier effect, do they?
Dan, I want to ask you about inflation. I know some of the viewers are often curious about what we're talking about around the set and the ad breaks. And Jeff and I were having this conversation about whether anyone truly knows what inflation's doing down the track, because we haven't been here before. And my point was that, well, you've got a lot of consumers doing goodness knows what ahead. Those behaviours have not been formed yet, whether they are willing to go out and spend money, whether they see a change in fortunes and they want to hold back, and whether that has an impact on supply chains as well. What's your verdict? Can you see clearly out down the line on inflation this time?
I think that what we are likely to see is that the elevated prices in the basic consumer goods and services will continue to be at those levels. We might see some easing, some cooling off a little bit of some of those, but the support levels on many of the commodities that we use on the day-to-day basis is feeding through to food, services, is feeding through shelter. So I think that we are likely to see an acceleration of inflationary pressures into the end of the year, and that we need to be concerned because this is at least the third print of inflation in which the so-called base effect is behind us. Therefore, what we are seeing is that a lot of those elements that initially central banks mentioned as transitory are quite more permanent and definitely more damaging for consumers and for real wages than were initially estimated. I think that inflation, in particular in the Eurozone, is going to erase quite a significant chunk of the recovery in 2022 if it remains at these levels.
Well, Dan, if that's the case, then bond yields are the wrong price, aren't they? If you continue to own government bonds, particularly G7 government bonds, at these yields, you are going to get poor very slowly.
Yeah, absolutely. Absolutely. Government bond yields are a reflection of financial repression. We cannot say that government bond yields are showing a figure that indicates that inflationary pressures are transitory when the central bank of that country, be it the United States or in the euro area for all of the countries in that area, when the central bank is 100% of the net issuances, because it's artificially depressing the yields. Therefore, the owners of those bonds are going to see a very important risk. One is real and nominal losses if tapering starts to take effect. The second is that they're taking a very aggressive bet on inflation coming back very hard down in 2022. So those two things indicate why it's very difficult for the Fed or the ECB to really taper, because they continue to need to be 100% of the net issuances of sovereigns, because the disparity between what an investor would require for those yields to be in the current conditions and the yields that we see right now is so wide that we would need to see in some Eurozone countries a 300, 400, maybe 500% increase in yields for investors to start thinking about purchasing sovereign bonds at the current yields. When looking at what they should be considering the inflation and the growth of the economy. Therefore, I think that, yes, government bond yields are not reflecting the reality. More importantly, the central banks are in a very, very difficult situation because the disparity between the reality and where they are is so wide that it can create significant ripple effects.
Dan, he sees risks everywhere, but he didn't nail down the one that he thinks will potentially bring us a very sharp correction. How important is China in the story at the moment? Is the risk likely to emerge from China, or should we be looking somewhere else?
I think that the risk from China is important and is being overlooked. If we look at the Evergrande collapse, the assets of Evergrande that are under this default are equal to the entire asset base of the subprime crisis that collapsed in the previous crisis. So it's a phenomenal situation what we're seeing in China. Both the crackdown is being overlooked and the importance of such a default. However, it is true that the Chinese market ripple effects into the rest of the economy are significantly lower than if it happens in the Eurozone or in the United States. In my opinion, I think that with such level of aggressiveness in monetary and fiscal policy, a correction of the magnitude that some people are expecting is very unlikely. But a correction based on adjusting to a reality of a market that has built very optimistic assumptions of both growth and earnings, not just for 2021, but particularly for 2022, that is more likely.
Good morning, Dan. Very interesting hearing what you had to say there. So you're worried about emerging bonds on the back of the Chinese corporate bonds and the Evergrande story, which is absolutely fascinating. You're worried about government bonds as well. How on earth can you say that IG bonds are a good investment? Bearing in mind the central banks have been, hoovering up as many IG as they have almost sovereign as well. How do IG present a port in the storm in the bond world?
Yes, we obviously have to be invested all the time, and we have to decide in an environment in which most actually asset classes are trading at elevated valuations where we find value. And what we see is that in 2021 and 2022, most of these investment grade issuers have done a very good job of improving their financial position and their balance sheet to levels that will help them navigate an environment of weaker growth and, more importantly, of a certain level of margin compression because of input price inflation, isn't it? So what we see is that when you look at the excess risk that you take with government bonds or with emerging markets, particularly looking at the risk that you take with currency risk, which is the one that we are more worried about, I think that developed economies investment grade generates in fixed income still some opportunities that are way more attractive despite being elevated, way more attractive than sovereign bonds and certainly emerging economies' currency risk.
I think the evidence is against you on the amount that their balance sheets are repaired. If I look at non-financial corporate balance sheets and their debt to GDP across US, that figure is still, let me have a look at the latest figure for you. In the second quarter of 2021, is still over 80% debt to GDP, the non-financial corporate debt. In the euro area, that is at 111.9%. In Japan, it's 113.5%. In the UK, 74.3%. Emerging markets, 101.5%. My point is here, Daniel, that you say that they've done a very good job of managing the balance sheet. I would suggest to you that non-financial corporate debt is at or close to some of the biggest levels we've seen in decades.
You've mentioned a very good ratio, which is debt to GDP, okay? That is correct. More importantly, it's the broad picture. That debt that you mentioned includes non-investment grade. But what I think is more important is debt to EBITDA. And if you look at, and more importantly as well, funds from operations to net debt. So when we look at, particularly in the Eurozone, where we see a lot more risk in equity than in bonds, if you look at those companies and what they're doing, I think that what's interesting here is that many of these large entities that are trading at too aggressive levels on the equity side are much more defensive and much more attractive on the fixed income side. So big corporations that in which the net debt to EBITDA, funds from operations to net debt are attractive within, and I think that that's the point that you also mentioned, within a framework in which that same measure that you just outlined, debt to GDP relative to bond yields, is phenomenally out of reality with sovereign bonds. And knowing that sovereign bonds are going to continue to be maintained artificially with very low yields from the activity of central banks, then that leads us to the investment grade opportunity. And again, it's all relative. We need to be invested all the time, and we need to look for opportunities in the world that we live in, not in the world that we would like to live in.
Oh, Dan, you just came up, you had to go at my debt to GDP version of the corporate. Your EBITDA was invented by analysts who wanted earnings before everything. But I've got to go, and I love the debate, so we'll do it another time. EBITDA, just remind our viewers, was kind of got popular traction in about 1999 when a lot of analysts were trying to espouse the virtues of technology companies that didn't make any money. Earnings like before EBITDA. Interest, tax,
but you also have
depreciation, amortization.
But still, if you don't like EBITDA, which is perfectly valid, I think that the most important ratio, and the one that I would look at when looking at investment grade bonds, is funds from operations to net debt. That is much more, and that is undoubtable. Right. That you cannot question.
All right. All right. Well, I can question. I'm a journalist. My job. I will question, Dan. There you go. Dan Lacalle, Chief Economist at Crédit Gestion. Always a pleasure, my friend. Thank you very much indeed for reminding me of the joys of EBITDA. Right, let's move on.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.